Right now, something is happening in the Middle East that most people are completely misreading. Everyone is watching the oil prices, the missiles, the headlines about the Strait of Hormuz, but they are missing the real story. They are not asking why Iran is letting Chinese ships through for free and charging every other nation a toll. Not just a toll, but demanding those payments in crypto or Chinese yuan. Bloomberg confirmed it. Iran is collecting fees at the world's most important shipping lane, and it is refusing US dollars. Think about what that means for a moment. The country controlling the choke point that carries 20% of the world's oil supply is not asking for the world's reserve currency. It is asking for the currency of America's biggest rival. And that single detail changes everything about what this story actually is. Because this is not an oil story. It is a story about chips, food, airline tickets, mortgage rates, precious metals, and a quiet but historic battle over who controls the global economy. The Strait of Hormuz sits between Iran and Oman at the mouth of the Persian Gulf. Every single day, approximately 20 million barrels of oil pass through it, roughly 20% of the entire world's oil supply. But oil is only part of what moves through that narrow passage. Qatar ships nearly 100% of its liquefied natural gas through the Strait of Hormuz. There are no pipelines that bypass it, no alternative routes. Every molecule of Qatari LNG that heats homes in Italy, powers factories in Belgium, and fuels industrial plants across Asia must pass through this single choke point. At its peak, approximately 100 ships transited the strait daily. That number has now effectively collapsed to near zero for Western vessels. Over 150 ships are anchored outside the strait waiting. Major shipping firms suspended operations entirely. And Iran is not stopping there. Qatar is the world's second largest producer of helium, responsible for approximately 20% of global helium supply. When Iran struck the Ras Laffan LNG facility in Qatar, it did not just disrupt gas supplies, it disrupted helium production. A disruption to Ras Laffan can take nearly 1/3 of the world's tradable helium offline almost instantly. Most people think helium is for balloons. The semiconductor industry knows differently. Helium accounts for 24% of total global helium consumption in chip manufacturing alone, rising toward 30% by 2030. It is non-substitutable. There is no alternative. Helium is used to cool the wafers, transport gases during the printing process, and keep the environment completely clean and contamination-free. No helium, no chips, and no chips, no smartphones, no AI servers, no data centers, no electric vehicles, no medical imaging equipment. The entire technology boom driving global stock markets to record highs depends on a steady supply of helium flowing through the same strait that Iran is now controlling. That chain, from a 33-kilometer waterway to a global chip shortage, is real. And almost nobody in mainstream financial media has connected it. And the consequences do not stop at chips. Iran is also disrupting naphtha, sulfur, and other petroleum byproducts that feed directly into fertilizer production and agricultural chemicals. The farm sector across the northern hemisphere is entering its critical planting season. Farm equipment runs almost entirely on diesel. When diesel prices surge, farmers plant less. Less planting now means lower crop yields at harvest. Lower yields in the second half of 2026 mean food prices rise precisely when consumers are already under pressure from every other direction. The food price impact of the current oil spike will not be fully felt until harvest season. Most consumers are not pricing this in yet. FedEx implemented fuel surcharges of 25.5%. UPS surcharges now exceed 25%. Amazon has announced it is adding a 3.5% fuel and logistics-related surcharge for third-party sellers in the US and Canada. Every package and delivery is becoming more expensive. Airlines face jet fuel costs that account for 20 to 30% of their operating costs. A 50% increase would wipe out their profits entirely. JetBlue has already made capacity adjustments. Higher fares mean fewer travelers. Fewer travelers mean the hospitality sector faces a difficult summer, precisely when it depends on peak demand. Consumer staples companies, including Procter & Gamble and Conagra, face rising ingredient costs and shipping costs simultaneously. The products that fill kitchen shelves are about to get more expensive. Before we continue, we covered how rising oil prices have historically preceded every major recession in history. The link to that video is attached in the description below. You can watch it after this. Now here is the part of this story that is genuinely baffling most investors. Precious metal gold hit an all-time high of approximately $5,600 per ounce at the end of January 2026. When the Middle East crisis exploded, Most investors expected gold and silver to surge further. War, supply disruption, global chaos. These are exactly the conditions that have historically driven investors into precious metals. Instead, gold dropped nearly 25% from its peak. Silver suffered what analysts are calling a flash crash, falling more than 8% in a single session. The safe haven trade that investors were counting on broke down completely. Why? Because the oil shock created what traders are calling a macro override. Rising oil prices push inflation higher. Rising inflation forces the Federal Reserve to keep interest rates elevated. Higher interest rates make government bonds pay more, and gold pays nothing. When bonds offer attractive real yields, investors sell gold to buy bonds. The more oil drives inflation, the more the Fed holds rates. And the more the Fed holds rates, the more gold falls. The war that should have made gold soar is actually suppressing it, because the same energy shock that creates geopolitical fear also creates the monetary conditions that make gold unattractive. This is not a temporary dislocation. It is a fundamental repricing of how markets work in a world where energy security is the primary driver of monetary policy. The investor who moved into gold expecting the traditional safe haven response is now sitting on significant losses. Meanwhile, their mortgage payments stay high, and the price of everything they buy keeps rising. Now, connect this to the bond market and to a threat most financial media is not explaining clearly enough. When oil prices drive inflation higher, the Federal Reserve cannot cut interest rates. We covered this in our yield curve and Japan videos. Every month rates stay elevated is another month that mortgage payments stay high and corporate debt becomes harder to service. But the Strait of Hormuz crisis is creating a second and deeper threat to the bond market, one that goes beyond Federal Reserve policy. The Petrodollar system, the arrangement under which oil has been priced and traded globally in US dollars since the 1970s, is the foundation of demand for US Treasury bonds. Countries that buy oil must hold dollar reserves. That structural demand keeps US borrowing costs low and allows the government to finance its $38 trillion debt at manageable rates. Iran is charging tolls in yuan. Saudi Arabia and China are working toward a framework that would allow oil transactions to be settled in yuan. Every barrel of oil settled in yuan, rather than dollars, reduces the structural demand for U.S. treasuries. Every reduction in treasury demand pushes yields higher. And most Americans still believe they are protected from all of this because the United States is the world's largest oil producer. That belief is wrong. The United States exports approximately 4 million barrels per day of light sweet crude, primarily to Europe and Asia. But American refineries were built to process heavier crude varieties, so the U.S. simultaneously exports its own light crude and imports approximately 6.2 million barrels per day of heavier crude that its refineries need to function. In essence, the world's largest oil exporter is also a significant oil importer. But the exposure goes even deeper. The United States imports enormous volumes of manufactured goods from Asia. Every factory in China that produces those goods just saw its energy costs surge. Those higher costs travel through supply chains and arrive on the shelves of every major American retailer within 6 to 8 weeks. Washington may believe domestic production insulates American consumers, but it imports the output of every factory in Asia that just became more expensive to run. Now here is where this story takes a turn that reveals something far more alarming than the oil price. When the Hormuz crisis deepened, President Trump called on America's allies to send warships and help reopen the strait. The response was unlike anything seen in the history of the Western alliance. Germany said, "This is not our war. We have not started it." Spain refused outright. Italy declined. Britain was vague. Japan, South Korea, and Australia all declined to join military operations. The EU foreign policy chief said the strait falls outside the bloc's area of action, adding that there was no appetite for expanding naval operations. For a moment, think about who these countries are. Japan gets 95% of its crude oil from the Gulf. Germany depends on LNG that moves through the Strait of Hormuz. Italy and Belgium get significant portions of their gas from Qatar. Every single one of these nations has a direct and immediate economic interest in keeping the strait open, and every single one of them said no. The German defense minister asked the question that exposed the real fracture. What does Trump expect a handful of European frigates to do in the Strait of Hormuz that the powerful U.S. Navy cannot do? That question was not really about military capability. It was about something deeper. After years of tariffs, threats, and diplomatic pressure from Washington, the allies that depend on the strait for survival declined to defend it together with America. The Western alliance that kept global trade flowing for 50 years is showing cracks at the exact moment it is needed most. And then Trump said something that shifted the entire equation. The Wall Street Journal reported that Trump told aides he was willing to end military hostilities against Iran, even if the Strait of Hormuz remained largely closed. He announced that the United States does not need to guard the strait, that other nations should police it themselves, that America would help if asked, but it should not be necessary. Think about what that means for the global economic architecture that has existed since 1971. For 50 years, the credibility of the petrodollar system rested on one promise. The United States military would keep Middle Eastern shipping lanes open, period. No negotiation, no qualification. The lanes stay open because America says so. That promise is now conditional. Iran knows it. China knows it. Russia knows it. Saudi Arabia knows it. Every oil-importing nation in Asia knows it. And if America steps back from that promise, the yuan does not just become an alternative to the dollar for oil payments. It becomes the currency of the power that kept the lanes open when America would not. Which brings us to the question this entire chain of consequences has been building toward. For 50 years, American economic dominance rested on three pillars: military control of shipping lanes, the petrodollar ensuring global oil demand translated into global dollar demand, and the manufacturing output of allies flowing freely to American consumers at affordable prices. All three pillars are cracking simultaneously. Iran is charging yuan tolls and letting Chinese ships through free. Saudi Arabia is exploring settling oil in yuan. U.S. allies decline to defend the lanes. Trump is signaling America may step back from its 50-year role as guarantor of global energy security. If America steps back, who steps forward? China is already there. Iran is already aligned with Beijing. Russia is already circumventing the petrodollar. The question is not whether the global economic order is shifting. The question is how fast. The Strait of Hormuz is 33 kilometers wide. But what is being decided there is not a military question. It is a currency question, a trade question, a question about which country will set the rules of the global economy for the next 50 years. We are not predicting a collapse. The signals are early. The system has buffers. But history suggests that when this many forces move in the same direction at the same time, the result is rarely small. We track the warning signs that move before the headlines do. If you want to see them before everyone else, hit the subscribe button now. And if you found this video helpful, like and share it with your friends. Thank you.